Well, Kyle, thank you for yet another thorough market activity report, and great job, team, on doing the whole annual report there. Very interesting insights and facts. Hopefully, you listeners felt the same way. Do let us know your comments and feedback on Twitter and all our communities. And it does look like T0 is getting very busy again, Kyle. That's only a good thing.
Yeah, you're not kidding. I mean, I think they've done almost 6 million in trading volume in this week, which again, we only had 60 million in all of 2020. So really says a lot about how the ATS has been performing. But unless we have anything else to add, I think it's ready to dive into this juicy main topic for the episode, Herwig.
I'm fully on board with that idea. You know, we've been hinting at it all episode. So GameStop has unveiled many of Wall Street's complexities and flaws. And as I mentioned, they won my company in the week because savvy players like Chamath are realizing that a blockchain is absolutely the answer to fixing and improving Wall Street as we know it. So public markets need security tokens, folks.
Absolutely. You know, no article sums it up better than the Fortune magazine article by Graham Moore, who is the head of tokenization at Polymath. But we're also going to break it down now here on the show. So let's dig right into it. And I think it's important that we start with the backstory that in the 1970s, which is when the NASDAQ launched, which ushered in the era of electronic trading. During that same time, the SWIFT network was also invented. And so despite some nominal improvements in that technology, public markets and financial systems still operate on this largely outdated technology. Now, despite the infrastructure changing, it really hasn't stopped other innovations from happening, like app-supported brokerages like Robinhood and the introduction of features like zero commission trading and leveraged trading for retail investors.
Yeah, so essentially new ways to bring investors into the Wall Street ecosystem, but no changes to the actual Wall Street infrastructure.
That's exactly right. So what we saw last week with GameStop was these innovations catching up to the old guard of Wall Street, showing the kinks in the armor. Now, like Graham's article, we see a future where security tokens disrupt a lot of Wall Street as we know it, but for now, we'll keep the conversation towards improving Wall Street, not just destroying it.
Right. So I think the best place to start there is Chamath's commentary on the All In podcast that he was featured on. He mentions a few solutions to all this. We can, add our opinions and expand from there, Kyle.
Yeah, I think that sounds good to me. How about you break it down for us? What did Chamath argue?
Well, the first thing Chamath did was we talk about the benefits of reconciliation and knowing who all the beneficial owners of a stock are, giving the example that you can't borrow on a share if you can't instantly prove that you own it, and pointing to the issue with GameStop at one point having a short position that is 136% bigger than the company itself. So this is exactly why he said it's the first obvious use case for blockchain, because by design, blockchain is a decentralized ledger showing who all the beneficial owners are.
Yeah, this whole thing is absolutely ridiculous. I mean, the idea that over 100% of outstanding shares could be shorted revolves around a concept that is actually something that is technically illegal, called naked short selling. Essentially, a naked short sale is a consequence of manual share management where short positions can be opened without actually registering a borrowed share to short. While naked short selling is illegal in the market for investors, it does not appear to be illegal for market makers, which is incredibly crooked and, in my opinion, is fraudulent. With a blockchain-based or blockchain-managed ledger, you can programmatically assign collateral and create a much higher level of accountability for outstanding shares. In a tokenized market, a short position literally could not be created without a smart contract requiring a deposit of that borrowed share. In this way, we can see exactly which shares are being borrowed or lended out, preventing what is essentially a double spend that we've seen by market makers, where they can lend out their share on the short markets multiple times. This causes huge issues when the positions need to be closed and those borrowed shares need to be returned, as there's literally not enough outstanding shares to actually fill those short positions, which leads to this absurd squeeze and price rise we've seen on some of these assets where everybody's caught with their pants down.
Absolutely right, Kyle. I couldn't have said that better myself. We can't have stocks be lent down more than once. That's crazy. And it ties into what Chamath said next. The other example that he mentioned as a solution is the need for more disclosure. So he says everyone should be forced to disclose what they own on a weekly basis so that regulators and watchdogs can comb through it. So this, of course, could be a nightmare scenario for large funds and not necessarily scalable, unless, of course, portfolios were completely managed with security tokens so that publishing the current holdings to regulators wouldn't even require a button to be clicked.
Yeah, this is also a very interesting point that he makes. If our listeners, if you're not aware, hedge funds with over $100 million in assets must disclose their holdings. I think it's approximately 45 days after the end of each quarter, and they got to file that to the SEC. However, it's kind of weird because they're not required to publish their short positions. They only need to disclose their longs. And so I'd guess this is to try to protect those funds from being taken advantage of through squeezes and over-leveraged shorts and stuff like that. But I still think that this should be revised, especially with blockchain-based ledgers that can assist with these disclosures, as they could be programmatically generated, as you mentioned, Herwig, and that kind of removes a lot of the scalability concerns that a manual process would require. But something's got to change there, I think.
Oh, completely, man. So next, we can look at Graham's article on Fortune, right? He points out that if stocks were tokenized, investors would have stronger controls because they could self-custody them and move them between brokerages that are able to meet their needs, in case Robinhood wasn't able to. So in this way, investors would be protected because they wouldn't suffer from being shut out of trading for having chosen Robinhood as their brokerage account. You can imagine that with the blockchain, it's easy to move custody around while retaining that beneficial ownership record and implementing those controls that we're talking about. So all these things are the SEC, something that they should be thrilled about, I think.
On top of that, margin and liquidity requirements could be programmatically set by the SEC and specifically the NSCC, which is the organization that does set those requirements for brokerages and the fees associated that would prevent the variability that we've seen in the derivative markets. So in this way, as hinted by Robinhood CEO Vlad Tenev in a Clubhouse conversation a couple days ago, brokerage firms would not be exposed to as much volatility in the margin requirements, which are set by those outstanding liabilities. Because this is really what happened with Robinhood, is that they went insolvent because they were unable to predict the fees that were associated with their outstanding derivative positions. And so by setting up these graduated programmatic fee structures, brokerage firms could understand their reserve requirements and could much better plan for these fees instead of being surprised by them like we saw last week, which really can lead to insolvency across multiple platforms and causing a small collapse in assets. And fortunately, they were able to raise that money and solve this problem quickly because it doesn't take too many days of insolvency before you start having bank runs and some real structural problems.
Oh, yeah, totally. That's a great point. And I also think there are some other crazy instruments that can be made up too, right? A staking program, for example, so help incentivize holding on to GameStop that can be created, encouraging stockholders to lock their trading for their shares. Yeah. Markets could also react in real time without being affected with multiple day lags, in settling the stock, which is having huge effects on the market price. The list of efficiencies can go on and on, not to even mention, all the cost savings, of course, that would be applied across the board. So were there any other ideas you wanted to mention in regards to all this, Kyle?
Yeah, I really think programmatic settlement is that final point that gets me excited. Market makers have so much control and leverage over the brokerage platforms and really the market as a whole. And this is something that we're seeing disrupted on the DeFi scene through automated market making solutions pioneered by Uniswap, Balancer, and those other decentralized exchanges. But you combine that with 24/7 markets that security tokens provide and immediate settlement where we don't have to wait multiple days and have some of these issues that come with multiple derivative synthetics because of the fact that there's too long of a settlement time. So I really think that with optimizing these processes, we can really create a healthier, more transparent market, which in the long run does improve liquidity, it improves price discovery, and improves international access into these markets, which are all things that we really need to optimize for. And these things take time, but here we see yet another opportunity for improving capital markets, and I'll tell you what, I'm here for it.
Same here, Kyle. Same here. The future of public markets look a whole lot brighter with blockchain. And that's all that we have for you today, folks. So thanks so much for tuning in to episode 79. Reach out to us on Twitter or LinkedIn if you have any articles to share, questions to ask, or feedback to submit to us. Otherwise, you can always join the community at stomarket.com/news, or you can even join our newsletter at newsletter.stomarket.com.
Catch you all next week. Thanks for listening.